All right, welcome back. I'm your host, Seth Golden, on behalf of Finom Group. This is our latest macro market video. I know that we have entered a seasonally weak period of the investing calendar year. I know investors are going to be bombarded by a plethora of headlines, some negative commentary, punditry questioning this, that, and the other about the year-to-date gains already in the market and, probably the depth of any future consolidation phases. I aptly titled this video, Investors Wager into the Eye of the Seasonal Storm. This particular part of the year, the August through September or into late September, part of the investing calendar year does typically offer lesser returns. In September, actually, since 1950, has been the weakest month of the year for the S&P 500, delivering on average negative returns, less than 1%, but negative returns nonetheless. So here we are in that seasonally weak part of the year. We've got all kinds of headlines about us. Not that we haven't throughout the course of this year, going back to last year's bear market. And so I guess I would encourage investors to keep their wits about them. You probably heard the phrase or colloquialism, keep your head on a pivot or on a, looking all about you. Don't. It's garbage. Okay. There's a lot of market or investor colloquialisms that are just that. They're garbage. They're not founded or rooted in any, factual representations, let alone have any practical utility with them at all. Stay away from some of these market colloquialisms that even from the smartest of, what are perceived to be the smartest investors and fund managers out there. And sometimes we just like to be heard, so we say stuff. It sounds, it sounds good, and it just, develops this life of its own, kind of like the 2023 bull market. So let's get into some content here. Let's look at some charts, some data, and see what we can surmise about the path from today or from the seasonally weak part of the calendar year through the end of the year. Something that this is one of my colloquialisms, in fact, but this one is true. This is a truism, I should say, of investor behavior. Those who are unwilling to accept double-digit drawdowns are less likely to receive double-digit returns. Take your drawdown like big boys and girls and reap those double-digit returns over time. The volatility is simply the price we pay for such returns. Essentially, most people are trying to avoid large drawdowns while at the same time trying to set themselves up for large returns. Double-digit drawdowns, double-digit returns. Those who tend to cut their time horizon short because their trade or their investment idea has achieved double-digit drawdowns are likely not going to achieve those double-digit returns. If you think about it, if you are not willing to take a double-digit drawdown, meaning you don't have the stomach, the intestinal fortitude to go through that, what makes you think that you're going to have the patience and discipline when your upside is 6, 7, 8%? Are you going to hold out better on the upside than you did on the downside? It's not logical, people. It's not. Human psychology is very constant on the downside and the upside. So if you think you're going to achieve double-digit returns, what do you have to do during those heavy drawdown periods? Keeping in mind that volatility is the price we pay for those future returns. Some seasonality, as I promised, right? So this is the cycle composite index from Ned Davis Research. They do it every year for the S&P 500, calendar year 2023. It's remarkable just how closely the S&P 500 has traveled this year along the cycle composite index. That's what this trend line represents here. And it's no coincidence that we peaked out in July, which is basically where the cycle composite index assumed we would peak out. And now we entered what looks like a lot of chop and slop. Again, the typical seasonal headwind for the S&P 500 is the August to September period. But if we're looking at the cycle composite index, it says the chop and slop period could last way longer here in a pre-election year. So keep that in mind. Essentially, we have the potential for a triple bottom within this particular time period. This bottom here lines up with the start of December, or possibly the last week of November. And the good news, higher highs, right? That's the good news. This is a lot of chop. This is a lot of maybe multiple contraction for those that have complained about the expanding PE multiple in a rising rate environment and with the 10-year yield above 4%. Well, this period right here may, reduce that multiple on the year, which is trading right around 19.5 to 20 times forward earnings. Higher highs by the end of the year, according to the cycle composite index. So what do you do during this time frame? Take advantage. When Macy's has a sale, 25% store wide, do you run away from Macy's? So if we have a 5, 6, 7, maybe even a 10% correction here during the seasonally weak part of the year, take advantage, just as you would at a Macy's store-wide clearance sale of sorts, which I'm not going to denigrate. Yeah, for those of you who know me well, you know how I feel about Macy's, Kohl's, Dillard's, and the general department store path going forward. All right, so with that, Mark Newton of Fundstrat, he's their chief market technician. He believes that this week is possibly going to be the trough. While the cycle composite index has played out well year to date, it doesn't predict the future. It assimilates the weight of the evidence on the equal weight for the S&P, 1-year seasonal cycle, 4-year presidential cycle, and the 10-year decennial cycle. We didn't follow the path perfectly last year for the cycle composite index. There's deviations, so do keep that in mind. And with that being said, Mark Newton believes this chop and slop period will be more consolidated than people think. More abbreviated is the best phrasing, I guess you can say. He thinks we're going to bottom this week and then head back to 4,600. Essentially, CPI, which is due out on Thursday, will prove the catalyst to the upside for the S&P 500. Historically, day 4 to month end returns are positive on average. Okay, so let's get into some of the actual data behind Fundstrat's research here. How much weakness might you expect to see when August's first 3 days are down and the year-to-date return is greater than 15%, right? So the first 4 trading days of August, I think, have been down. But if we just look at the first 3 days and when the S&P 500 was up 15% or greater, historically, day 4 to month-end returns are actually positive for August, with a 78% positivity rate, meaning 78% of the time, August is positive given this criterion. It does actually support Mark Newton's technical analysis. So this quant data here supports Mark Newton's technical analysis, suggesting this consolidation period may be short, shallow, and abbreviated. In our weekly macro market research report 2 weeks ago, right, which I co-author with my partner Edward Cordoba, I stated, given the data, insights, observations, and analysis above, in our actual report, not from Mark Newton. I would be anticipating a 5 to 7% pullback in the major averages in the Q3 period, but offering such an outcome has only a 40-60 probability for the S&P 500 and a 50-50 probability for the NASDAQ 100, in my earnest opinion. Right? So we look at data throughout the week, and in our macro market research report, all of the quantitative data, all the technical analysis, all the macro fundamental occurrences and trending GDPs, we're looking at all that data. And while we would be anticipating a 5 to 7% pullback, based on all the data, all the analysis, we only think, such a pullback it has a 40-60 probability. So a lesser probability. Now with the NASDAQ, because it has higher beta, we think it's a 50-50 chance. It's a toss-up. In keeping with some of our additional analysis, this we also offered 2 weeks ago from Oppenheimer's Ari Wald. We think a bearish market view carries a poor risk-reward balance when we consider our high priority to the S&P 500's bullish trend and low priority to market timing. Meaning, look, if we think we're going to get a 5 to 7% pullback, what do you do ahead of that? Well, Ari Wald of Oppenheimer thinks you don't do anything. You just ride it out. It's a normal and to be expected, consolidation period for the average year has 5% pullbacks. The average year going back to the 1980s. So this is normal and to be expected. You don't need to go out there and hedge your portfolio. You don't need to go out there and buy puts, so on and so forth. Just ride it out, because while this is something we're anticipating, we're not guaranteeing it. The market doesn't guarantee us anything. What are the odds markets will express a 5 to 7% pullback into the fall? That's the question you need to ask yourself. Oppenheimer also last week raising our target price for the S&P 500 year-end 2023 to 4,900 from 4,400. But they are reducing their earnings projection to 2020 from $230 a share. Interesting. So they believe there's going to be a higher price to earnings multiple, even if less earnings altogether. Okay, now let's look at some quantitative data here. This comes to us from Wayne Whaley. This looks at the August through December S&P 500 performance after the S&P 500 and the NASDAQ have both delivered 10% plus gains from January to July. Hit the pause button if you need to, listen to that again. That's the criterion, okay? When that happens, the August through December performance, the positivity rate, meaning how many times up versus how many times down, 17 times up in the August through December period, only one time down. And the one time was 1987. Look at the median and average gains during that August through December period. The median gain, if you toss out the low and you toss out the high, is 6%. So, but, is this going to be like 1987? I think I have a chart. We'll get to that. Nonetheless, this tells you again what to do during this potential chop and slop period. We talked about the probability of higher highs is elevated, and this quantitative data helps to validate that sentiment. All right, nonetheless, right? JP Morgan, we've heard this from much of the punditry since 2022 that a recession was imminent, even though they have to push it out every single stinking quarter, right? But here's JP Morgan, the latest from Michael Feroli. The end is not near. And basically he's saying we have removed consideration of a mid-year recession from our tree or consideration. We raised our assessment of likelihood of soft landing, in which inflation declined sufficiently to provide space for central bank easing to sustain growth to 35%. Here's what I say. All right. And most of this color coding that you'll see when it's in this darker shade, it's from Finom Group. It's representing our sentiment, if not mine directly. And this is what I have to say to the economist of the world. Dear economist and Wall Street strategist, when you get the macro and micro outlooks wrong, this does not mean the market is wrong, right? Because that seems to be what they've been promoting in financial media all year long. Something's wrong with the market. The macro backdrop, the yield curve, the leading economic index being negative for 15 plus months, that can't be wrong. It has to be the market. But as I'm saying here, this does not mean the market is wrong. When you get, as an economist, when you get the macro and micro outlooks wrong, this does not mean the market is wrong. It means you have credentials, but maybe you just don't have the qualifications to do what you're attempting to do as an economist. There are currently 1.6 job openings for every person unemployed. That's a hint for you economists out there and pseudo-economists to boot. Nevertheless, JP Morgan removing their forecast for a recession in 2023. Mike Wilson of Morgan Stanley also, kind of taking a mea culpa lap as opposed to a victory lap over the last couple of weeks. One of Wall Street's staunchest bears, Mike Wilson, says the stock market pivot rally may go even higher. He's starting to look at what I informed investors would happen to Mike Wilson this year, which is the likeness of 2019, which was a pre-election year, just like this year. It was also the year where he forecasted in 2018, he basically believed the S&P 500 would go nowhere. It would stay at 2750 in 2019. He kept his bear market forecast from 2018 into 2019. I warned investors, if you follow him in 2023, as you did in the bear market for 2022, we're probably going to have a repeat. So what happened to Mike Wilson back in the 2018-2019 period, where he missed the entire rally of 2019, and he so far has missed the entire rally of 2023. Mike Wilson suggests that 2023 is like 2019. In 2019, multiples expanded with flat earnings on a year-over-year basis. We were not counting on multiple expansion, no kidding. Market could continue higher, but be wary over treasury yields. And indeed, we've seen a rapid rise in the long end of the treasury yield curve. 10s, 20s, 30-year treasury bonds have all notably ticked higher in the last couple of weeks. We'll see what happens with them going forward, of course. Savita Subramanian, most of you know, she's a perma bear. She was bearish coming into this year. B of A Subramanian likes small caps. She likes small caps over the crowded S&P 500. It's not just that she got the call wrong for this year, right? She had a 3,900 price target for the S&P 500 for 2023. Now, she has since revised that up to 4,300, which the S&P blew past, getting to 4,600 on an intraday basis. 4,588, I believe, is the year-to-date closing high. But she also got the area of the market wrong, right? She prefers small caps over the crowded large cap S&P 500. Any which way you cut it, like she's just done a terrible job for a Bank of America. Only twice since 2011 when she took over as the chief or the head strategist at Bank of America, only twice since 2011 has she seen her price target achieved, and they were both down years in the S&P 500. With that being said, Finom Group did, we offer trade alerts, we offer investment ideas to our Finom Group premium members throughout the course of the year, and we decided that, back in late June, we would start building a core holding in the small caps, which were lagging year to date. The premise was that we believe small caps would catch up to one degree or another with the large cap indices. We started buying the IWM, which is small cap Russell ETF, around 175, got our cost average to about 180, and we decided to kick it out. We cut our investment time horizon short. Why? The more and more study that we did about the current macro market cycle, we came to believe that this is not an early cycle phenomenon, where we're coming out of a bear market and people believe that it's a new cycle. Sometimes it is, sometimes it's not. The economy drives earnings, therefore the economy drives the S&P 500 over time. So when we look at the macro, the fact that we did not have a recession last year does not reset and introduce a new cycle this year just because we have a new bull market. We have a continuation of the cycle that began anew in March of 2020. This is not a new cycle. Ergo, this is probably still late cycle. And ergo, that is why small caps are lagging. Small caps lag in late cycle environments. So while we thought this would be a good longer-term investment vehicle, small caps, we decided that cost average at 180, it got to 191. We took our profits and said, thank you very much. We'll be moving on. July 12th, we were done. It was a quick, shorter than expected recession, but shorter than expected investment. But again, you gotta study, and you gotta stay true to what the fundamentals are suggesting. Since that time period, we actually delved more into the growth space. Even with the outperformance in the Qs, the NASDAQ 100 year to date, we said, all right, we'll take those profits from that small cap IWM investment, and we'll start, reallocate them to the growthier areas of the market, identified mainly by the Qs, NASDAQ 100, NASDAQ Composite. So since that time period, here it is, July 12th to yesterday, indeed, the best performer is the NASDAQ 100. It doesn't mean I can't predict the future. Nobody can. Small caps could easily outperform from here, but so far that proved a wise decision on our part. Let's hope we have wiser decisions going forward. But here's another chart also validating our consideration, even if we look at non-recessionary years, right? Non-recession bear markets, like last year, how is the Russell 2000 or the small cap index ETF performing in non-recessionary declines? Well, when the S&P 500 has its first major advance off of its major non-recessionary decline, this is the average path for the small cap Russell ETF. This is the year-to-date performance, or the performance since the major advance in the S&P 500. We are not just lagging the S&P 500 when it comes to small cap. Small caps are lagging themselves in the first year off of a major S&P 500 advance. This is literally the worst in history. You may be credentialed, but you're clearly not qualified to do what you're doing. All right, moving on. Let's see. Earnings. Earnings are getting better and better. We came into the quarter with tracking. This is as of June 30th. They were expecting 7% decline in earnings for the quarter. It's 5.2% decline so far. It wouldn't surprise me if this got into the fours. Earnings, again, coming in better than expected. In my opinion, this is your put. Right? This is your put on the market, because from here, earnings are expected to grow year over year. There's only so much downside in the market when earnings are going to grow in the out quarters. Couple weeks, about 3-4 weeks ago, back in July, we talked about the fact that for the first time in this new bull market cycle, we've had a monthly MACD bullish crossover. That's a major signal. Historically, after that major move in the MACD, a bullish crossover. 1 year later, positivity rate is 85%, double-digit gains, average and median. 3 years later, jumps up to 90, almost 93%, the positivity rate, and look at the gains. Just saying, folks, good things are happening. I had mentioned earlier, right? Is this going to be like 1987, given some of the data that we looked at earlier, right there in the Wayne Whaley study, the August through December period? Could this turn out to be another 1987, the only time August through December was down after both the NASDAQ and S&P 500 delivered a 10% gain in the January through July period? So what this data helps to assuage those concerns. This is from the Lighthole Group. Does a breadth confirmation impact the rest of the year stock market returns? Well, it does. This is the August through December performance as well. When the S&P 500 has made a 52-week high in July, which it did, and the NYSE advanced decline line also makes a 52-week high. So the first column is when those two feats of strength occur: S&P 500 52-week high, NYSE advanced decline line 52-week high. In other words, breadth, the advanced decline line, is confirming price, the S&P 500 52-week high. When that happens, only once did the market deliver a negative return of less than, that's 0.1%. Every other time, it's been positive. The average return in the August through December period, 6.5%. Here is that 1987 period. We've had several declines. The second column did not. This is when the AD line does not make a 12-month high. So in 1987, you didn't have breadth confirming price. In these occasions, more often than not, when you have breadth failing to confirm price, you have a number of negative returns. And the overall return on average is negative 1.1%. So there you go. You can assuage those fears of a 1987 like August through December period. Last of our studies from Wayne Whaley, again looking at the August through December period. A perfect 8-0 when the first week of August is down more than 1%. And the January through July period, the S&P 500. The S&P 500 only is up greater than 10%. So the first week of August, down more than 1%, which we were, and the S&P 500 is up more than 10% in the January through July period, there are no negative returns. And the average return in this period is much higher than our prior study from Wayne Whaley. A different set of criteria in looking at the first week of August. We had a 76% retracement in the S&P 500, a retracement of the bear market decline. Historically, market has never retested the lows when that has happened. Another way that we look at this chart, a 76% retracement, we put it on this chart here, major S&P 500 declines, basically 19% or greater, and you retrace 76% of the decline. Like, this is not like the 73, 74 period. This is not like that 1987 period. This is not like 2020. This is not like 2000, 2002, folks. Talked about Amazon. For a Finom group, this has been an investment idea that we promoted starting last year. Cost average in the low $80 range, folks. Low 80s. Stock broke out. Here was one of the charts that I had offered. Or this is kind of a quant and technical analysis here. What am I identifying with these boxes? Major years where Amazon stock delivered a negative return. But what happened after that? Every single time, going back to 2009, when Amazon delivered a negative return for the year, the next year the stock hit all-time highs. The very next year. This is another chart I had offered. This was the closing high of 144 and change. This year so far, the only stock in the FanMag cohort of stocks that has not hit a 52-week high is Amazon. It's the only one until recently. So this was a bit of foreshadowing, if you will. These are the latest notes from Morgan Stanley. They have a $175 price target on Amazon.com. All right, with that, I hope you enjoyed this week's video from Finom Group. We hope to see you next time. If you would like to get our weekend macro market research report and our weekly state of the market reports, don't be shy, folks. Subscribe. Take care, everybody.